Hey everyone, in this video I'm going to talk about what the Fed said today and what it has to do with inflation and some research I've been working on. Okay, let's get right into this. Right after mentioning that coupon code for the amazing programs does expire tonight. It is Cinco de Mayo, happy Cinco de Mayo, so check out that program or all of the programs because you can bundle them together and get an even better deal. Link down below, use that coupon code, and I'm super excited to have you in the programs. Alright folks, let's get into this. So first things first. Inflation is obviously massively debated right now. How we measure inflation is massively debated. The fact is we've printed a lot of money, but the velocity of money has gone down. So it makes sense that money is circulating less. But it is also a fact that lumber prices hit a record high today, when they've consistently been hitting record highs. That copper prices are up like crazy. We're talking 50-60%. Wheat prices are up. I mean, you look around, used cars, new cars, everything is up, with the exception of maybe like apparel. Okay, apparel's down, big deal. But a lot of prices today are up substantially, and they're increasing substantially, and the Fed's argument is obviously that these increases are due to supply shortages and total shifts in demand and expectations all brought on by COVID. And in some sense, it makes sense. When you get a pandemic and it totally changes the way we do business and even think about doing business, we need less of some things and much more of other things, and it totally changes and screws up everything. Instead of people needing work computers, they now need more computers at home, which changes chip dynamics. When we think, oh, the pandemic's going to stop people from buying cars and people are going to be spending less because there's going to be this big long recession and people stop producing chips, but then all of a sudden we get the Larry Kudlow V-shaped recovery. We start buying chips again really fast, and potentially even more than we had before because cryptocurrencies are going to the moon. You know, it kind of makes you go, oh, yeah, that's definitely going to screw up some supply chains because, well, that's pretty much exactly what's been happening. So what I wanted to do is digest a little bit of what the Fed said today, but then also try to look at history a little bit. The easiest way to look at history is kind of just look at what inflation has done over the last 100 years. So take a look at this right here. This is the last 100 years, sort of a chart of inflation here. This is from tradingeconomics.com. They've got a really nice long chart here. One of the neat things about this is it really shows us that at the turn of the century, we actually had deflation. This line right here is sort of a deflationary period of time, and that we were really struggling to even see inflation. We had spikes and bouts of inflation, especially after World War II. We saw this massive dip during the Great Depression. We also saw a really massive peak over here around 1948, 49 as we had a recession. But what's fascinating is, with the exception of this sort of 1948, 49 peak, and the exception of what happened after 1971 when we left the gold standard, we really haven't seen hyperinflation in the United States. So, for example, if we take out the gold standard mess up over here and these wage and price controls that were implemented by Nixon, if we take that out over here, and we take, even if we leave this spike in over here, whatever, leave this out, remove the gold standard removal here and the Nixon era, remove that for a moment. What we notice is that inflation historically stays pretty dang on average low. You know, folks like to say, oh, this is the great moderation right here since the 80s, that inflation only recently has had this phenomenon of being low. And that lately we're all freaking out and complaining about this little line right here, this movement up. And then maybe that line will go to, oh no, 3%, or maybe 3.5% for a couple months. And maybe it'll stay 3 or 4%. I'm not sure if it'll actually go to 4%, but maybe it'll stay high for a few months consistently. And then the big question is, which way is it going to go? Well, if history has any guide, it tends to vacillate, it tends to go up and down, but it tends to rotate down after even temporary peaks. In fact, when we look at any of the peaks of inflation we've never had consistently high inflation. We've had very, very short-term bouts of high inflation. We've had elevated inflation over here, right? I mean, these are potentially years right here where you've got inflation sitting around 6, 7, 8%, but the peaks over 10%, relatively short in duration. Something that I did find very interesting as well that somewhat relates to the burst in spending that we've had here with temporary spending, which is very much what we have right now. We have temporary, let's spend big on a stimulus, let's spend big on infrastructure, and then ideally stop spending, right? We get this short-term bout of spending, fix what's broken, and then ideally we stop spending. If we keep spending, it becomes a problem. But a period in time in history where I found we had a burst of spending, not necessarily something crazy like getting off the gold standard or a war, but a period of time where we had a burst in spending, and it was a short term, it was a temporary boost in spending. What happened afterwards was sort of a little strategy that I was looking for. And so what I found was right here. It was in the period of around 1948-49, after that recession, after the Korean War ended, 51-52, we actually saw this very, very moderate period of inflation over here. Inflation bobbing around short-term deflation right here. Inflation around 2-3%, dropping to 1.25% for almost a decade here. And really not rising again until 1969, where inflation ran up to about 5%. And so we had this really period here of low inflation. And the question was, okay, well, why? Why did we have a period of low inflation in the 1950s? And the research that I was doing at the time was mostly we had this period of low inflation because of globalization. Better partnerships with the world after war, able to develop in other countries or export our goods to other countries or reduce costs by working with other parts of the world, technology and technological deflation, the start of TVs and radios and things that reduce expenses in our life to make things easier. And we really saw this burst of spending followed by a period of real calm. So burst of spending from Korean War, followed by a period of extreme calm in inflation. And it really wasn't until what happened in 69 to 71 when we started having wage price controls, where prices were artificially limited. And when those limits were removed, we saw a surge in inflation. Then we left the gold standard, another surge in inflation, because these artificial limitations that were imposed in the late 60s were all of a sudden removed. And so we saw this sort of unleashing of this great inflation. And really, this was the result of a manipulation of leaving the gold standard, a manipulation of having purposely tried to keep prices down over here in this late 60s era. But short of these manipulations, when we removed these manipulations, we had a really incredible period of no inflation, where we didn't have a war. And this war ended, the Korean War ended, so we had the inflation sort of driven by war going away. And then we really got to this period of normalcy and inflation, which is very much similar to what we've seen for the last 30 to 40 years. And so this belief that, oh my gosh, there's going to be this hyper rampant inflation is a little bit challenged by history. That sure, is it possible we're going to see some elevated numbers that go high on this chart, 4 or 5%, and we see a spike here? Yeah, but history shows it will tend to go back down, short of crazy manipulation in prices, like things purposely trying to keep prices down. Now, in an interesting way, some might say, hey, well, we have manipulation in the fact that the government is printing, but this isn't trying to manipulate by keeping prices down. This is just the government's printing money, and that's one of the things, well, the government does very, very well. We know that. And so looking at this chart, yeah, we might say, hey, well, it's all the money printing that's happening. That's what's going to cause massive, rampant inflation. We're going to see one of these spikes again. Well, even if we were to see one of these spikes and we saw, a 10%, 15% inflation, or even the inflation that we saw in the 70s, which was a period of time where the Federal Reserve was very passive. They were very, very slow at reacting to inflation. We don't expect them to be slow at reacting to actual inflation again, or persistent inflation, I should say, not actual inflation. We expect that the Fed has hopefully learned. We wouldn't actually expect these spikes to last long if we had them. So history gives us that bottom line. History gives us the bottom line that absent artificial and massive changes like purposely trying to limit price growth and then seeing the balloon pop on that, or purposely getting off the gold standard, or war, short of those things, we didn't really see massive inflation. Even when we've been doing insane money printing from 2010 before the COVID pandemic, we didn't get massive inflation. QE1, QE2, QE3, QE infinity, we haven't seen massive inflation. It's bizarre. It's very, very bizarre. And so this kind of brings up some of the things that the Federal Reserve said today, and I'm trying to put this all together here and decide, okay, so what the heck is actually happening here? So the Federal Reserve today, multiple members had a few things to say. Charles Evans, for example, Charles Evans, he's the Chicago bank president of the Federal Reserve. Something else that's unique about him is he is also a voting member of the Federal Open Market Committee, which helps set interest rates. And he said today, quote, the Fed still has, quote, some ways to go before we reach our dual mandate goals of maximum and inclusive employment and inflation averages 2%. For now, the policies are likely to hold for some time. So usually sometime is 3 to 6 months, aka no taper announcement yet, not even thinking about it. But he also goes on to say, and this was another step further here, he goes on to say, I personally think that the achievement of sustainable inflation averaging 2% is a lot harder than people think. Okay, so let's try to register that for a moment. The achievement, he's saying inflation is an achievement. If we can get inflation, it's an achievement. The achievement of sustainable inflation averaging 2% is a lot harder than people think. And he goes on to say, and so I'm not in a hurry in any way to have that discussion about pulling back on asset buying. It's really weird. It's counterintuitive. But when we look at the chart, it kind of also makes sense. It's been hard to consistently remain at 2%. Even back in the 1950s and 60s, we had a very hard time having persistent inflation in America. Even back in the World War era, we had massive spikes in prices due to war and shortages caused by war. Guns and butter, right? But they were short-lived, very short-lived periods. Let's go on to some additional quotes here. We have Charles Evans going on to say that that there are fears that when the economy reopens and begins to work again, that inflation might spiral out of control, even as we get through those inflation or those supply shortages. He says, quote, I would not be concerned about inflation moving persistently too high unless we saw quite outsized movements in financial market pricing at the longer maturities or in survey-based measures of inflation expectations. Okay, so that's complicated. Basically, in plain English, what he's saying is, yo, when you really got to start worrying, and this is a nice heads up for you to actually pay attention to, okay? But when you start worrying is when the 10-year Treasury yield, which shot up, flattened, and is now trending down, what he's saying is, when you start seeing that skyrocket again, that's when you want to be more concerned. Or when you start seeing people's inflation expectations for 2023 and 4 and 5 come in at 3, 4% over and over again, that's maybe when we're going to start having problems. But we're not seeing those right now. Because inflation, and this is something that's so weird about inflation, so much about inflation has to do with our expectations. Let me ask you this, and this might be a more simple way to think about it, because it helped me think about it a lot more, is do we actually think that real estate prices are going to go up 15% a year like they did over the last 12 months? Forever. No, that'd be insane, right? I mean, like already real estate prices went up 15% and people are like, bubble, that's it, it's getting ready to burst. Because prices going up is not very normal. It's kind of abnormal to see those sorts of growth numbers. It's weird. It's abnormal to see the growth we saw in the stock market last year, and that's why we're having such pullbacks now in stocks. Despite amazing and smashing earnings, we're having pullbacks in stocks. Because so much growth has already been priced into 1 year, and it's weird. It's kind of like, do we think that we're always going to have to buy cars at sticker because prices are going up for cars? No. Do we always think that we're going to be able to get a used car for 2 or 3 years, drive it around, and then in a year sell a Toyota Camry back to the dealership for $4,000 more than what we paid, a year or two later? No. We don't expect those prices to continue to go up. We realize that the prices of housing are high right now because there's no inventory. We realize the prices of cars are up right now because there's no inventory. We realize the prices of chips are up right now because there's no inventory. We realize the price of lumber is up right now because there's potentially a lack of inventory. Okay, I don't know that much about the lumber markets, and there are anecdotes of people going, oh, I see plenty of lumber at the yards. No, we don't know how many of those are dedicated to contracts, or already, I should say, designated to contracts in that way. So it's very interesting. Kind of makes sense when we look at it from that point of view, oh yeah, I guess we probably wouldn't really expect year-over-year persistent inflation over and over and over again. Fed Loretta Mester, she's part of the Cleveland Fed, she says she expects 6 to 7% economic growth over the term of this year and falling unemployment this year. But she says that her positive baseline outlook depends on appropriate monetary policy, which in her view will be basically being very accommodative for, quote, some time to support the broadening of the recovery. This is an interesting argument. Broadening of the recovery. We want to support the broadening of the recovery. So we don't just care that the stock market's gotten back, or that hedge funds are doing well, or that tech companies are doing great, even though their stock prices might not much going up. The companies are doing great. They want to see that broaden out. They still want to see hotels doing well and restaurants doing well. Got time to go. Now, she also responds with concern over a jump in inflation. She does say that she expects to see a notable jump, her words, notable jump in inflation over the next couple of months, with an overshoot of the Fed's 2% target. But she believes that will be temporary, and that the Fed will remain highly accommodative because that'll be temporary. Notice so far all of these people are very much echoing what Jerome Powell has said, which is a little bit different from what Kaplan over at the Dallas Fed has said, that maybe we should taper earlier. But everybody else, especially the voting members, because Kaplan's not even a voting member, the voting members are like, no, we're on the right path. We're going to wait. We're going to wait. Boston Fed Eric Rosengren, he says that the implications in the market that we see right now are that our policy is going to remain accommodative until the labor market can consistently help deliver the Fed's 2% inflation goal. But again, we look at that chart, it's been a little bit difficult to see 2% inflation. So we'll see. I think a lot of this is, in a weird way, going to come down to our expectations of inflation as society. And what's crazy is our expectations of inflation in society are actually dictated, well, not dictated by, but they show up in, they're evidenced by trends in the Treasury yield curve. This is why every single day we do market open, market close, you see me talk about the 10-year Treasury. Because when that thing spikes, that means the market broadly is like, oh, we got to be worried about this for inflation purposes. Lately, the market's been digesting data that hasn't even been like mega hot. It's just been like, okay, I mean, those are good numbers, but they're not like overblown numbers. They're not overly hot numbers. All right, Treasury yield's been falling. It's weird. It's crazy. It's something to pay attention to. And I know how counterintuitive it feels that maybe we will go back to normal levels of inflation. But that's the way I'm investing right now. And I know that might sound crazy, but I strongly believe with over 70 to 80% conviction that we're going to have these crazy price increases for the next 3 to 4 or 5 months. And then we're slowly going to inflect back to the downside, at least for the next 2, 3, 4 years thereafter. And who knows, maybe some other black swan comes up during that time or after and screws things up. But so far, I'm not seeing the long-term persistent inflation that a lot of YouTube videos sort of fearmonger right now. Anyway, these are just some of the observations that I'm making. I'd like to hear from you. Let me know what you think. Check out the programs, link down below. Remember to use that coupon code expiring today. And folks, we'll see you in the next one.